Well, welcome back, everyone. I hope you're having a wonderful holiday long weekend. Markets open again on Tuesday, but how we ended the week is quite important. I just got off the phone with Rob and we were talking about market structure, some of the key events that are happening in the week ahead of us, and how things can pan out. At the very highest level, and most importantly, we've got some index divergences. What you're looking at right now is the Champion Trend Pack Toolkit added on top of the price of the DIA ETF, which is the Dow ETF. The Champion Trend Pack is on there. There are a few other tools as well, including Rob's ITP tool, which is a marketplace tool that has some targeting associated with it. Now, what I want you to really focus in on is where my cursor goes on the left-hand side of your screen over here. We made a high in the Dow ETF, the DIA, on the 18th of July. We'd made a high prior to that on the S&P, and I'll show you that in just a moment. That high then led to the Japan Monday low, and we are now in a breakout to higher highs. So a marketplace that is attracted to bigger, widely held names, but technically signaled with the Champion Trend, Champion Cross, range breaker, breakout forecasters, and price riding above those speed lines headed up towards a target 2 up here. That is a bullish posture. Now, rationale behind that bullish posture, in particular, flight to safer quality names that are lower in volatility, but these do contain some of the key FANG names. But the Dow is one of those indices that's quite interesting. It's a price-weighted index. It's not a market cap-weighted index. So the bigger the sticker price, the more influential that individual name would be against the index. Now, to get a really good sense of where the divergences are, we know that the Dow's at a higher high. So let's close the Dow off temporarily and let's expose the S&P 500. And I want to kind of zoom in and focus in on the key things that are important. So that's why I'm kind of releasing things here at a very measured pace and making sure that your eye is focused in on what's of most importance. When you look at the SPY, what you're looking at in the middle of your screen right now is the SPY ETF. Now the SPY, lots of sectors, over a dozen. We've got balance in that index, and there are lots of areas that can backfill some slack that's created in the market by, a sector or two. Now we know that the Qs have been underperforming, but focus in on the high first. So we made our highs right over there on July the 16th, and Japanic Monday low, same for everyone, August the 5th, and up we've gone. Now we've had an absence of breakout forecasters on the SPY. The last one that presented right over there is on the 26th. And the reason I focus in on this is the Champion Trend Pack Toolkit developed by Rob Hoffman, the only 33-time real money on-site trading champion that we know of out there. Over decades of work, this has been reduced down to something that's easy to digest. All you got to do is take a moment to learn it. We've got stage 1 with Champion Trend, Champion Cross, stage 2 with Wealth Signal, stage 3 with breakout forecasters, and each stage has an element of tradability or a trade trigger, and there's something unique that usually happens at the end of each stage, in particular the end of all 3 stages. The sequence ends, and typically when we have an absence of 3 to 5 bars of no breakout forecasters and or 2 or 3 bars and we get a bearish cross of the speed lines, we have a higher probability to see price come back down to test the last, second last, or sometimes even the third last, which is a little higher in this case. So we'll just go first, second last, breakout forecasters on the page there. And that's quite a move back down indeed. Now that is a risk that's on the table. However, we saw the Dow breakout. You're in a bullish signal state on the SPY, and the divergence comes in when we start looking at the Qs. What you're looking at now is the SPY and the Qs together. So in a much more focused manner, what you can see here is the high on the Qs made a little earlier than it was on the S&P 500, and of course started its move down and started to foreshadow that we are more likely to be headed down ahead of the SPY as well. That's key as well here. Now, when we've gotten off that Japanic Monday low, the Qs have not had the same level of attraction. And one of the key pieces of rationale here is it's done incredibly well over the longer term. So if I take the Qs and just bring them out to you full screen over here and give you a view of how the Qs have done over the big picture. Now it's going to be a lot on the screen here, but you can see an incredible run, and we can take this back even further. It's been the driver of US and in many degrees global markets as well. Now, what's happened is the overvaluation concern, the overvaluation premium that's in the market there, has prompted firms to say, we're probably at the spot where we lower these areas and we have higher growth in other areas, or we have less growth overall and we see more declines potentially coming in an area like the Qs, so counterbalance it with something else, or reduce here and go somewhere else. Now, what I typically see when I see a divergence like this is an opportunity to have a pump and dump in the market, wherein we break out on the SPY. We don't see too much more on the Qs, and if they don't get busy catching up, as you heard in Rob's video from last weekend, well, guess what? The whole thing can come right back down on us. And it's not just the Qs. Another poster child for stocks that have a higher risk profile in general and a higher cost of capital, meaning it costs them a lot to borrow money to operate. You can use the small cap index, the Russell, as one of those poster childs. And what do we know when we look at the Russell? We know that the point in time of making the high, very similar to the S&P 500. In fact, it was the day after, the 17th. It actually did come back up and made a higher high at the end of July. Same low, Japanic Monday, August the 5th. And on the way back up, it's come closer to achieving almost a beat of its highs back over here. So a little bit better in terms of that positioning relative to the Qs, but a good chunk of that again was a short squeeze, which was also a good chunk of that move up over here. So we want to be mindful that if it's hollow volume, if it's short squeeze volume, if it has not been able to make a higher high in an area that should be leading risk, if the marketplace is actually feeling safe about buying more, you're usually going to see the highest of the high risk outperform, and that's not happening. So when we sum it all together and we look at the SPY, the Dow, and the Qs, we know that the cross-pollination of stocks, top 10 holdings, in the Qs and the SPY, there's a lot that are similar. Without those holdings that dominate the Qs and are a big part of the SPY, without those heavy, big Mag 7 market cap, megalithic kind of stocks moving, there can be problems. So in the week ahead, we've got manufacturing data from the US market, manufacturing PMIs on Tuesday, and that's for the hard goods manufacturing. We've got the Bank of Canada giving us their rate statement, and that's going to affect things as the dollar's in a bit of a bounce and it's added a little bit of risk to the picture. Nonetheless, the market did end up closing closer up towards highs, as we see here in the 563s for the SPY, supporting a potential continuation and a test of all-time highs, which are spitting distance away. However, when we look at the services data and the jobs data, Thursday and Friday respectively next week, we have to be very cognizant of, are prices actually coming down? Are wages actually staying up? Or are they compressing? And those are going to be some bigger moving events into the back end of next week. I look very much forward to sharing insights on that as we move through the week. For now, we're positioned technically to be signaled to continue. The continuation is fraught with these index divergences that we wanted to highlight in this weekend's video. And while these divergences are in play, beware of false breakouts. Have an incredible rest of your holiday long market weekend. Looking very much forward to seeing you. For those of you that are part of Wealth Charts and in the Active Trader room over at becomeabetrader.com, looking forward to seeing you in the rooms. For everyone listening in, stay safe out there. All the best to you. Health, happiness, and to your wealth. Have a great rest of your day, and thank you for watching.